Back with you. This is Michael Yorba on CEO Money. All right, my guest this segment is Scott Brown. He's the CEO of Equity Armor Advisors. Scott, welcome to the show.
Thank you, Michael. Thanks for having me.
All right, my pleasure. Give the audience a little flavor for who we're working with today, and then let's dive into the first topic today, volatility.
Sure. So Equity Armor Advisors, we put together, I've been in the market at different levels for 31 years, and my partner, Don Vickery, has been doing it for about 25 years. And together, we're basically quantitative analytic builders of portfolios. Don's particular expertise is in forensic accounting. So one of the things that kind of separates us from a lot of people is that we've generated a earnings quality score that uses forensic accounting to score every stock in the available universe on its forensic ability to, we're trying to spot those anomalies that where inventories are building or receivables are building or things that are kind of hidden on the balance sheet that a lot of people wouldn't normally just find. And so we try to score those stocks. All of that in an effort to bring the cream to the top in terms of any particular strategy we're looking for. What are the best stocks to own in that portfolio? So Don and I have this experience, and so we've built these quantitative models, 3 of them that we use simultaneously, one being for GARP, which is growth at a reasonable price stocks, one for dividend stocks and trying to hold the best dividend for the long term, and then also what we would call defensive earnings, which to us is stocks that most of their earnings is in cash. And so in a market downturn, those cash earnings generators are going to hold up better than some of your gap generated earnings stocks that are on the growth side. And we combine those 3 models into a portfolio of 30 stocks. And then the next piece that we bring to the table is that we went out and found the leading expert in volatility trading, which is Brian Stutland. He's on CNBC twice a week as the volatility expert. You can see him weekly there. And so we overlay on these portfolios a volatility trading model where we're staying long volatility so that in the event of any downturn or volatility in the market, the portfolio is hedged and is able to capture gains from the volatility side of the portfolio while the equity side may be trending downwards and basically cuts most of our downside capture 50% or more. So, just to give you some quick examples, on our GARP strategy, if you go back to 2008, using the vol overlay in our GARP model, the market was down 37%. Our portfolio was down 12%. If you look at the income strategy, it was actually up 6% that year using volatility in those cash earning generating companies I was talking about. And then in a total return, these are different products that we offer to the investor. The return for that year was minus 6% compared to the minus 30%. So you can see that using volatility, and a lot of people don't have a good way. A lot of people think you trade the VXX and that gets you exposure to volatility, not understanding that it's probably one of the worst ETFs ever made, in the sense that if you don't have timing, sometimes down to the minute, you're going to be on the wrong side of that trade, and it's just a sort of a losing decay instrument. So Brian's come up with a really creative way of staying long volatility in a way where using futures contracts and in some of our portfolios, the ETNs, to balance a position that allows us to cheaply hold volatility as a hedge against the portfolio and protect it in those downturns.
One is Ed Baxter, Bison Creek Capital. I'm familiar with some of the things you did as far as the portfolio is concerned, and using GARP and also using the obviously it's a forensic with regard to the balance sheet, because obviously nobody ever relies on their balance sheet. We know that, right?
Right.
In my own portfolio, I used to go long and short the S&P to augment the performance of the portfolio without necessarily selling the baseline equity portfolio. Based on the way you've described your particular strategy here, would you argue that you're a Warren Buffett style value investor?
Yes, I would say that our quant models very much lean towards the Warren Buffett value type positions. And then, of course, we use, as opposed to shorting the S&P, we just hold a long position in the volatility portion that gives us the protection, especially against the systemic market risk that's out there. So, for example, your previous interview right before I came on was talking about some volatility he sees here in the next week or so with the S&P, and our portfolios don't basically worry about that because we've got that volatility covered through we basically hedge about 10 to 15% of the portfolio, depending on the overall portfolio's beta to the market.
Well, obviously, beta plays a big role here, and looks like the majority of what you're doing from a beta standpoint is probably somewhat low from a portfolio measurement standpoint. Is it your goal to bring less beta to the portfolio while protecting that portfolio with the options you have on the VIX?
Yes. I mean, the higher betas will show up in the GARP stocks, but when you get to the dividend payers and the cash earners, they're going to have lower beta. But we take into account the entire 30 stock portfolio and its beta to the market when we set what percentage of the portfolio we're going to cover with vol.
When you look at the portfolios and the positions you put into them from a criteria standpoint, what does it take to get kicked out?
That's a good question, and we've had a few companies that get kicked out during. These are basically set up to emulate a unit investment trust. So we're basically creating monthly portfolios that start on the first of the month, and they're meant to be held 12 months in a day, so that the investor gets long-term capital gains. But we do have the ability to go in and exit a position when the theory has changed with the company. And so if we monitor, of course, earnings during earnings season, and if something comes out during that earnings season that says, where they missed earnings and they're lowering guidance going into the future, there's been a change to the thesis that brought it to the top of the portfolio. We also, by the way, monitor all of the stocks. So when we select them, let's say the December portfolio came out today, and it shows us the top 30. Now, if a stock that's in that top 30 drops all the way into the bottom 30% of all stocks covered based on something that happened during that year, that's an automatic exit. But we're also just monitoring earnings and earnings forecasts and guidance that the company gets on a go-forward basis. And if you get a change, Philip Morris is one that we just exited last week. It was in the portfolio. They had a poor quarter, and things didn't look the same going forward as we had anticipated when it came into the portfolio, so we exited it and moved into a different position.
All right. We've got about a minute left on the segment here. Before we go, any takeaway messages you want the audience to know about, aside from the strategy that you're talking about, before we close out, Scott?
Just the main thing I would share with everybody is, no matter what portfolio, if you have exposure to the equity markets, find a way to hedge your portfolio. And my opinion is volatility is the best way to do that. And, if you can't figure out how to do it, give us a call. We can overlay on any portfolio at any time. And so I would say that's the best thing to do, because it protects you. This market is in a 9-year bull run like none we've ever seen, and it's going to go down at some point. And when it goes down, you need that protection. It's just like buying insurance on your home.
Scott,
you pay for it and you pay for it and you pay for it, but when that flood comes or that fire comes, you're gonna be so glad you had that insurance.
Thank you, Scott.
Absolutely, you bet.
Scott Brown, EquityArmorAdvisors.com. You've been listening to CEO Money with Michael Yorba, Ed Baxter, and the segment brought to you by Tycon Partners. Thanks for listening.